I'd like to actually start with an extract from an article that appeared in the Financial Review a couple of weeks ago. I'll just read it. The Rudd government wants Infrastructure Australia to find ways of streamlining the delivery of big projects to help lure $1.3 trillion in superannuation funds to invest in domestic infrastructure. In fact, that same message was reiterated recently by Anthony Albanese, the Federal Minister for Infrastructure, at a conference I attended recently in Sydney, as well as Sir Rod Eddington, the Chair of the newly established Infrastructure Australia, at a recent lunch in Melbourne. You know, $1.3 trillion is a heck of a lot of money, and there's no doubt that that could be put to great use here in Australia. But what's the issue? Well, I think there's no doubt that superannuation funds find infrastructure assets attractive. Most of our investors, and I think most of you in the room, would have an allocation to infrastructure ranging from 5 to 15%, sometimes higher. So it's not the asset class itself that's the issue. I think the key issue here is the fact that a lot of funds have been actually investing overseas to the detriment of investing here in Australia. And that's what that article and Albanese and Eddington are trying to address. So I'd like to explore in my presentation that trend a little bit further and look at some of the issues that are currently influencing investment opportunities in existing assets here in Australia, as well as some new assets that we need brought forward into the market. I've got three key questions that I want to address in the presentation. The first one is quite simple. Is infrastructure still an attractive asset class? I think with the general decline in global stock markets over the last 12 months, listed infrastructure stocks have come out of it pretty badly. So what does that mean for a super fund with an investment already in infrastructure or looking to invest in the future in the sector? The second question is, what risks actually exist in infrastructure investment models? And I'd like to highlight what I think are some of the key features of infrastructure funds and assets that an investor should be looking out for going forward. And thirdly, what does the future hold for superannuation fund investments in infrastructure? I actually think that we're now moving into an exceptional time for acquiring infrastructure assets in the secondary market here in Australia, and I'd like to explain to you why I believe that's the case. And when I'm talking about secondary assets, I mean assets that have already been built, are up and operating, and are being sold for the second time or third time into the market. And going back to the quote that I had on the previous slide, I'd like to highlight what I think needs to change to attract Australian superannuation funds into new greenfield infrastructure opportunities in Australia. Before I start exploring those questions in a bit more detail, I'd like to take a few more minutes just to do a little bit of scene setting in terms of industry funds management, our business model and our investment history, since I think it provides a useful context to some of the investment structures that I'll be exploring later in the presentation. IFM's, I think, a unique company, established back in 1995. We now have over $17 billion worth of funds under management. In terms of our ownership structure, it is unique in that our owners are actually our investors. And here, if you can spot your logo, you'll see that you may be one of the 37 industry superannuation funds that owns IFM. And they represent the savings of over 5 million working Australians today. And that, for us, is a very powerful marketing message when we go out into the market to acquire assets. So those 37 industry funds include many of you in the room today: Australian Super, CBUS, HESTA, Vision Super, CARE. They own a holding company called Industry Super Holdings, which owns a much more familiar brand probably to many of you, Members Equity Bank, and as well as IFM. And we offer a full suite of asset classes to investors. I think what's important, and you'll understand the importance of this when I look at some of the listed infrastructure fund models in a moment, is that by having our owners as being the core group of investors, we have a very simple, clear and transparent business model. We simply invest on behalf of our owners to generate as high a return as possible and to do that at the lowest cost possible. And importantly, there's no fee or profit leakage out to third parties or shareholders, or importantly, conflicts of interest in trying to manage numerous competing investment interests. So it's a very clear, simple investment structure, with our focus primarily on our owners and the 5 million working Australians. Infrastructure investment is a global business now, and typically you'll find Australians, and I suppose the odd Irishman, involved in key roles and transactions across the globe. Since we attended this conference last year, we've opened a New York office to complement our bases in Melbourne and London. I think that's absolutely vital if you want to source the deals that, from the ground up, manage assets in local territories on a day-to-day basis, and in establishing and growing local networks. So our growth has therefore continued. We're now almost at 100 staff in IFM and over $7 billion worth of superannuation funds invested in infrastructure. We have two infrastructure funds with over $3 billion worth of funds under management in each one. On the left-hand side, the two funds are unlisted. They're open-ended, so there's no short-term or short to medium-term pressure to liquidate assets, which are good and high quality and doing good work for us. The two pie charts on the slide, on the left-hand side we have the Australian fund, which has a heavy focus on electricity generation, particularly on the renewables side, and also an exposure to most of the airports here in Australia, as well as toll roads and public-private partnerships. And on the right-hand side, a much more diverse group of assets across electricity generation, telecommunications, pipelines. And this diversity within the two funds is actively managed by us to ensure that the investors are not overexposed to any one particular asset class or to one particular territory, particularly in the international fund. Okay, so that's the introductions done. Now I'd like to turn to the first question I posed at the start of the presentation. Is infrastructure still an attractive asset class? I'm asking the question since it's probably in most of your minds, particularly given the extent of media coverage in the last couple of months that's focused on the demise of some very high-profile listed infrastructure stocks, in the last 6 months, and particularly just in the last few weeks. Before I start answering the question, useful just to do a very quick infrastructure 101 and look at some of the main appeals of the infrastructure asset class. Typically, they offer monopoly characteristics. Usually when you have one, you don't need another one, so you only ever provide for one electricity distribution network, for example. You have an inelastic demand curve, so you're providing an essential service to people. And the prices go up, people still need that service. So you're quite well protected against economic shocks. High barriers to entry. We're not going to see another Cairns Airport being provided, so linked to the monopoly features of infrastructure. When you have one, that is usually the only one you need. And given the amount of capital that goes into creating these significant assets, they offer a very long duration investment. And I think that's what's most appealing to superannuation investors, where you have long, stable, steady cash flows that matches a superannuation fund's forward liabilities. Taking the theoretical to the practical, this next slide just summarises some of the findings for our own ongoing risk analysis of our infrastructure assets. You'll see from this diagram just in the top right-hand corner, just showing the gearing levels for each of our assets within the Australian Infrastructure Fund. And the average gearing level there is around 56%. We compare that to our competitors, which are at levels of around 60 to 70%. We're very low geared, long-dated maturities on our debt, and a high proportion of which is fixed in terms of the interest rate going forward. So very stable debt structures in place. We also do a series of sensitivity analysis on an ongoing basis, looking at the extent to which some of our infrastructure assets might be affected by economic slowdowns or increases in input prices, whether it's petrol affecting toll roads or airports, or labour and material supplies affecting, say, our Pacific Hydro business, which is developing new wind farms and hydro facilities around the world all the time. And that bottom right-hand graph in the corner just shows that the majority of our assets are in that sort of green to orange area, which is basically indicative of the fact that they're quite well protected against economic downturns. And when we run economic shocks with each of these investment models, we're only seeing very small movements in valuation. So they're quite robust assets. So I've painted what is a pretty rosy picture in the world of infrastructure. But what's happened to create the dramatic demise we've seen recently in the value of ASX-listed infrastructure stocks? This graph shows the performance of a basket of 20 listed infrastructure stocks from June 2003 up until basically last week, and you'll see that they enjoyed a pretty strong run right up until around May last year, and then there's been a pretty significant downturn since then, and that downturn is still continuing. I need now to make an important distinction between what we've been seeing in the listed market to what was being experienced in the private infrastructure market where IFM invests. I think many of these listed funds that are captured in this graph have debt not just at the asset level but also at the fund level. And one listed organisation may also have a number of satellite funds that may also be listed, and this makes for a very complex structure and one that has often been geared up to the hilt. So when the subprime crisis hit, any stocks that were highly geared experienced the practical problems of trying to service a high volume of debt, and many of them also had to refinance during the credit crunch. So you had extremely tight credit markets and banks demanding a reduction in gearing. Market sentiment as well moved dramatically away from these vehicles that were complex and hard to understand and highly geared. So to emphasise, I think it's been the way that individual infrastructure assets have been packaged up and sold to investors, and not the actual individual infrastructure assets that are experiencing the problems. The individual assets, as I explained earlier, still exhibit strong fundamental features of infrastructure, and it's primarily the vehicles that they're incorporated within that have been the problem. So what does this actually mean for an infrastructure investor? Well, for an investor such as IFM, it's actually very positive. Why is that? Well, within the context overall of a significant infrastructure backlog in Australia, current market estimates suggest that you could be spending up to $400 billion worth of value in infrastructure going forward to 2020. But what is happening in the market is that the more aggressive buyers of infrastructure assets that we've seen operating in the last 3 years are now becoming sellers, primarily because they're now being priced at levels that makes it very difficult for them to raise equity and to acquire new assets. They're struggling also to refinance their debt, and hence they're being forced to reduce their gearing levels by selling assets. And they're continuing to face significant negative market sentiment because of the structure of their investment vehicles that are ultimately not very investor-friendly or well-aligned to investor interests. So the secondary infrastructure market now in Australia is probably the best it's been for some time for a conservative investor like IFM. The supply of secondary assets coming onto the market has increased while the number of buyers has decreased. Combined with that major push by federal and state governments to boost infrastructure spend, the conclusion that we draw is that this is actually a terrific time to be looking at an infrastructure investment. My early observations of why the listed infrastructure funds have experienced the problems they have were raised in a much more high-profile manner by a report issued by Riskmetrics in its critique of listed infrastructure funds back in April this year. I've now got a few slides that just pick up on the criticisms that they were making, and to highlight to you as investors in infrastructure what you should be looking for if you're considering an additional investment in the sector. The first set of issues, the first one, in fact, is pretty fundamental, and it's the extent to which an asset manager's interests are actually aligned with the investors. Like, for all intents and purposes, there should be 100% alignment with fee structures that reward a manager for all the right things. In other words, enhancing returns to you, the investor. To have no competing investment mandates, so the manager is always looking after your best interests and not another competing fund with a different set of investors. And thirdly, not having related parties obtaining work on a non-contestable basis. If I just bring up a quote which tries to encapsulate some of those issues and criticisms that Riskmetrics were making. This is from Bartholomew's in the Business Spectator, and he says that management agreements have been generating controversy because of their opacity, their duration, and the way they entrench the managing entity and act as a poison pill and deterrent to take over regardless of the performance of the fund. So these management contracts are essentially impregnable your fund's travelling pretty poorly, you would like somebody to take the fund over, but because of that agreement that's in place, there's essentially no interest in the market. So you're locked in with the existing manager, whether he is performing well or not. I think management contracts and fees are close to everybody's heart, and it's useful just to have a look at one example that we've been exploring in some detail recently. And this is just the fee structure and the volume of fees that have been charged to investors by one pretty high-profile listed infrastructure fund recently. The headline fee offer from the manager to an investor is 1% base fee with a 15% performance fee above a certain benchmark. But if you actually look at this graph in some detail, and I'll just try and simplify it as much as possible, if we work from the bottom up, the blue slice is essentially the base fee, and that's fine. That's you paying the manager to look after your investments, and that chugs along quite nicely at around the $20 million mark through to current day. The next slice is an orange. It's orange on my screen, orangey pink slice, and essentially that's the incentive fee. That's what the manager gets for making that fund perform above a benchmark. And you'll see that in 2005 it was going pretty well, but by 2006 and 2007 it started to diminish away to nothing. So he's getting nothing because the fund is not performing well. The next slice is a bit intriguing. We don't actually know what this is. It's actually called a management services fee, but surely wouldn't those management services be incorporated within the base fee? So it's quite coincidental that you're seeing the incentive fee decline to zero, and there's an introduction of a management services fee which lacks clear definition. And then finally, this massive chunk that's sitting in the top of the graph, this purple chunk, this is fees paid to related parties. So the manager is giving other groups within that entity an opportunity to provide a service to the fund on a non-contestable basis. And if it's chugging along at around $30 to $35 million, but then look what happens in 2007. It undertakes a massive increase from 35 million to over 100 million. At the same time as your fund is underperforming, there's no incentive fee being paid, and the market cap of that fund reduced by 50%. So to us, we're just in amazement at the level of fees that are being paid out, not to boost the performance of the fund. The market cap's dropped 50%. There's no incentive fee, and you've paid out $106 million for related party services. Let's hope those services have some sort of impact on this fund going forward. Just to put that in context, overall fees there around $135 million. For IFM, we charged on our Australian infrastructure fund, which has got a value of $3 billion. Our fee was around $25 million, basically a quarter of what we're seeing on that slide. So, great work if you can get it, but as an investor, you're probably not getting very good value for money. Just moving on, what other features should we be looking for in an infrastructure fund? I think ideally open-ended funds are the way to go, so there's no pressure to actually sell good assets at the wrong time of the market, and of course generate significant fees for the manager along the way. And also there's a need for transparent and consistent valuations so that you as an investor know exactly how an asset has been valued and its performance relative to other similar assets around the world. The next slide actually has a case study which goes back to that first point about being forced to sell assets. And we look at that grey box, and what that is indicating that this essentially is what we think is a contrived transaction by a major ASX-listed infrastructure fund, and essentially to avoid the risk of a potential sale of an asset, they restructured it from a limited life investment fund into a holding company. And that restructure, if you look at the fees that actually were triggered through that restructure, $119 million termination fee on top of a $91 million performance fee to related parties. That's $210 million worth of fees for an asset that's valued at $377 million. So 60% of the value of that asset, through a contrived transaction, generated fees back to the manager. Again, not good value for money to the investor. Final key feature is the need for sustainable funding structures. You'll see from the first quote that the point being made is distributions should be affordable and paid out of free cash flow and not debt. Risk metrics are making the point that models that are paying distributions out of debt or through transactions are not sustainable in the long term. And we've seen at least one infrastructure fund come to the realisation that that type of model is not sustainable. And here we've got a quote from Chris Lynch from Transurban. They undertook a pretty fundamental restructure in June this year. And he's making the point that the assets, as I was making the point earlier, they're still fundamentally strong. Here he's saying the assets continue to generate strongly underlying cash flows, but because of the restructure, ramping back distributions, paying distributions out of free cash flow, the company's now a cleaner, easier to understand investment proposition, and we're now seeing many of the listed infrastructure funds starting to reconsider these types of restructures and making the models much more understandable for investors. So I mentioned earlier that we're moving into quite an exciting time for infrastructure investors such as IFM. Good assets are coming onto the market at attractive prices, and the competitive environment has eased somewhat. I'd like to go through two case studies now just to illustrate that point. Two slightly different issues that I'm trying to bring out in the case studies. The first is a transaction that we undertook in the US over the September to June period when the credit crunch was actually at its worst. And I want to use this to illustrate that if you stick to the basics about what makes a good infrastructure investment and the fundamentals around the asset, you can actually still do good deals in the current market. And the second is a recent transaction that highlights the sorts of assets that are coming onto the market in Australia. Okay, in terms of the first case study, this is an asset that we call the North American Energy Alliance, and we had to rebadge the asset. And if you look at the NAEA logo up in the top right-hand corner, if you've got really good eyesight, you'll see the Southern Cross, which is our little bit of Australian branding for some American assets. This case study focuses on a suite of gas-fired assets that we purchased. They're located in 5 locations in the northeast part of the US, and Consolidated Edison, a major power company, was selling these assets off to focus on its main core business of generating steam for New York. The process was competitive, and to bid we teamed up with Allco Finance, which I'm sure many of you will be aware is a structured finance and funds management company. And they were in for about 1/3 of the equity, and IFM was putting up around 2/3 of the capital needed to acquire this asset. We were actually successful in winning the bid in December last year, but the next 6 months were actually pretty unprecedented for us in terms of the challenges that were presented in trying to reach financial close. I'd actually just like to take you through a bit of a timeline which just illustrates the sort of challenges that we were faced with. Basically, the deal kicked off in September and October last year. Became aware of the transaction, hooked up with Allco, started their due diligence. Managed to get a bid in November. We got closer to the target price, submitted another bid, and hey presto, within 3 months we had success. We were the winning bidder, and we managed to lock up a debt package, however with quite a significant number of conditions precedents that we had to meet within a 6-month time period. Consolidated Edison, to protect their position, asked us to put letters of credit on the line to the value of $150 million. So we didn't complete the transaction. We were up for a cheque of $150, which was pretty significant. So in January we started addressing all the condition precedents, but at this stage the subprime crisis was really starting to hit its zenith. We had 16 major investment banks around the world announcing losses of $75 billion, which was making most debt providers anxious in the market, including our own. In February, the real brown stuff hit the fan, with Allco really going into a tailspin, and their stock market price plummeted, and essentially they had to exit the transaction. So that was a major drama for us, and we knew there was $150 million on the line, so what do? Well, we decided, with the support of our board and investment committee, just to keep going. In order to help us with the heavy lifting, we appointed Merrill Lynch and a specialist electricity company called Competitive Power Ventures. But at the same time, things weren't getting any better in the market. Bear Stearns collapsed, and most debt markets around the world had essentially closed, and pretty much everybody was anxious around the transaction. In April, a major hurdle for us, not just the state of the debt markets, but we needed to obtain regulatory approvals from 4 federal entities and 2 state entities, and these were very challenging for us as a relatively new investor into the US, trying to convince these authorities that we were acceptable owners of these assets was very challenging. And if we didn't get one of those approvals, then we would have lost our $150 million. So the pressure was really on to convince them that we would be good owners. The other item there on that little segment is the Clear Channel court case, and I think this was a very important context for us. It essentially relates to one of the largest leveraged buyouts in America, and the debt providers in that transaction were trying to wiggle out of their obligations to provide debt for the leveraged buyout. They were brought to court, and the court found in favour of the company, so the banks were told, even though the markets have hit rock bottom, you guys still got to stump up for the cash and provide the debt. Lo and behold, within a couple of weeks we had also locked down our debt and satisfied the bank with all our conditions precedent. So I think that was a very helpful case to take place at that point in time, particularly given that subprime losses from that 16 banks I mentioned earlier had gone up to $200 billion. So in May we managed to reach financial close and follow through with a second financial close in June. And since then we've been establishing the NAEA office and commencing business as a new owner of that asset. So why was the asset attractive to us, but more importantly to the banks and the regulators? I'll just quickly rattle through these items. Essentially, a very young suite of assets. They're gas-fired, so very environmentally friendly relative to coal generation. You've got a good exposure across a number of markets. You've got embedded growth potential within the assets, so you don't need to go and compete and buy new, clean assets going forward. You can build on what you've already got with an existing strong management team. From the banks and the regulators' point of view, I think the key issue for them was that IFM was able to de-risk the assets. So we had pretty low gearing in place at around the 50% level, and 90% of that debt was fixed and hedged. So they were pretty confident that that debt level and structure was sustainable. We also had long-dated hedge contracts in place, so 80% of the power was wrapped up in long-term contracts. So it was a steady and reliable cash flow coming forward. I think the final point on that slide is extremely important in that the regulators particularly sort of understood the owner-investor model that IFM encapsulates. We've got a long track record in infrastructure investment, and we had an open-ended fund structure. So they were convinced that we were going to hold these assets, as we've done with all the other assets that we own, for long periods of time, and would be good guardians and corporate citizens. I think I'll just put up a quote and some very kind words from Bartholomew's again, from the Business Spectator, who just acknowledges that this was a very difficult transaction, and the investment model that IFM offers really came of age with this transaction. I think the moral of the story very much is, and this is the point I was making earlier, if you keep it simple, you de-risk the assets, and you embrace the fundamentals around infrastructure, you can actually get a very good deal done in the market. In terms of what's happening in the Australian market, this is an example of a secondary market transaction that we were able to undertake in the last few months. Essentially, we were an existing shareholder, but bought the remaining 70% of Babcock and Brown Power's interest in Ecogen, 2 gas-fired power stations here in Victoria. Again, great set of assets. Will look good when emissions trading system is introduced relative to coal. Very environmentally friendly in terms of water use, and significant embedded growth potential, particularly at the Newport power station, which wasn't actually priced into the transaction. So, we have major entities now selling assets into the market at very attractive prices, and these are good transactions for a company like IFM. I'd like now to focus on some of the bigger picture issues in relation to Australia's demands for new infrastructure. And if you remember the quote right at the start of the presentation, what does Kevin Rudd need to do to try and lure superannuation funds into financing the deal flow going forward? Infrastructure, most of you have infrastructure exposure, and I think the challenge for Kevin Rudd and his government is actually getting us to invest in Australia, not in infrastructure per se. And if you look at this graph, On the left-hand side, you'll see the volume of investment we've made in Australian infrastructure. That's over 13 years, and it's sitting at around $3 billion. But in 3 years, through the International Infrastructure Fund, we've invested $3.8 billion worth of funds. So you'll see that the international market to us is a lot more attractive than the Australian market. You know, the value opportunities are much more significant. The market's deeper, there's larger transactions, and often less competition because there's fewer entities able to actually bid for very, very big infrastructure assets. A lot's been talked about public-private partnerships in Australia, and they have been the main opportunity for private sector investment in infrastructure in the last few years. And again, this sort of puts PPPs in some sort of context. You know, in the last 8 years, PPPs, you've been able to get about $1.2 billion away in PPPs in Australia, but compare that to what we've done in other Australian assets. We've got 1.7 away, and internationally, $3 billion invested in international infrastructure. So PPPs, there's a lot of focus on them at the minute, but typically they only allow you to invest. They're very highly geared, invest very small amounts of equity. And for us, they'll always remain, interesting, but a pretty small aspect of the infrastructure market going forward. Just to prove or illustrate the point a little bit further, these two projects, if we look over the last 3 years, these two projects are probably the largest PPPs that have been transacted in the market. Royal Children's Hospital and Airport Link Toll Road. And you'll see on the right-hand side of the slide the potential to get equity invested in those two projects. You can probably get away about $500 million. To work on those projects, we would have had to tie a team up for 2.5 years, involving 10 to 15 staff. And if you compare that to actually what we did do over that 3-year period, if you manage to count those, there's actually 16 transactions or 16 investments over that same time period, involving the same number of people within IFM. So, for us, investing or tying up a large resource for that time period really doesn't make much sense. We've been able to invest, if you look on the right-hand side of that graph, almost $3.5 billion worth in those transactions. That's 7 times the amount that we could have got away in working on just 2 PPP transactions. The time and effort involved in getting a PPP up is just one of the issues. I think there's another major issue in terms of misalignment of interests between the sponsors of PPPs and what governments are trying to do, and equity investors. And this is a toll road model, which I'll try and illustrate the point. This curve represents the normal sort of risk profile of a toll road. Typically, you go through a bid phase, then you construct the asset, then you're into ramp up as traffic starts moving on the road, and then you start operating as a mature toll road asset. So the risk is coming down over time. But I would argue that the risk profile is completely different for an equity investor like IFM or a superannuation fund or a mum and dad investor. If you look at the volume of cash that's actually coming out of these toll road models, you'll start to get the sense that we're not getting a very good deal as an equity investor. At the bid phase, at the end of the bid phase, you've got the investment bank and the contractor, who comprise the sponsors, taking a significant amount of fees out at the front end, and other advisors, including traffic forecasters, are taking their money as well. During the construction, contractors are taking their return. And then when we get into the operation of the toll road, investment bank usually has an advisory fee running throughout the life of the asset. Operations and maintenance, they've got no exposure to the traffic risk. They keep trundling along. Bank debt is usually exposed to a much lower traffic risk in the model. And we have equity, an IFM or a super fund investor or a mum and dad investor standing with 100% exposure to traffic risk. And from a sponsor's point of view, I think their point of highest risk is actually at the bid phase. But for an investor like us, our point of highest risk is actually at day one, when the asset's been built and the asset's open for traffic. Now, most of you will be aware of some pretty high-profile I suppose, examples of where traffic forecasts have really not manifested when the toll road has opened. I think this is the main fundamental issue with this model, in that essentially in day one during the bid phase it's a shootout on traffic forecasts. Essentially the highest traffic forecast wins the day, but is the traffic forecaster there on day one opening traffic? No, he's taken his fees and walked off at the end of the bid phase, and it's you who's invested off the back of those traffic forecasts that is standing holding the can. And I think if we look at some recent toll roads, we're seeing variations of 50–60% between the lowest and the highest traffic forecast. And what confidence does that give to an investor going forward on the next toll road transaction? Which traffic forecaster are you actually going to go with when there's that much variation between the 2 or 3 main industry players at this point in time? So I think the market's recoiling from the toll road model as well. And if we look at some high-profile listings recently, Briz Connections, listed in July, dropped 60% on day one, and this morning was trading at 8 cents. It was supposed to list at $1. And River City Motorway was trading, again, it started at $1 and was trading at 18 cents. So this is not a sustainable model. It will not get us as an investor bidding on this structure. And I think the market has spoken as well that the days for this toll road model are certainly numbered. Not a good structure to be considering an investment in. So the ironies are pretty obvious for us. We are investing a great deal of our money offshore, but here's an example, a pretty contrived image, you'll agree, but here we have the Murray River, basically on its last legs, really crying out for billions of dollars of investment. But what's actually been happening, you have Australian superannuation funds and other investing funds putting upwards of $15 billion worth of investment into English water companies over the last 3 years. And the ironies are obviously pretty obvious, and it goes without saying that us and 3 or 4 other major Australian investors would much have preferred to invest that money here in Australia. But the investment structures for the water sector in particular just are not conducive to major private sector investment, apart from the odd public-private partnership from time to time. So how should the government address these issues, trying to stop that flow of superannuation funds offshore? We want to invest here. We don't want to support British water companies or American power stations. We'd like to put the money into Australia. So the Rudd government has sort of woken up to this fact and made some major sort of changes to infrastructure and energy policy in Australia. And let's just see what they've done already. First of all, they've established Infrastructure Australia, and Anthony Albanese proclaimed it as a new era of nation building in Australia. Now, there's a council that actually supports this new body, and we're lucky enough to have Gary Weaven, the chairman of IFM, appointed onto that council. So there's a terrific opportunity there for the industry super funds to help influence and guide the work of Infrastructure Australia. In terms of what they'll actually be doing, they've announced a $20 billion Building Australia Fund. Not too sure what they'll be spending the money on, but this next series of work in terms of undertaking an audit, compiling an infrastructure priority list by March next year, and developing nationally consistent guidelines for PPPs will help guide where some of that money goes. And in addition to Infrastructure Australia, we've seen a pretty dramatic turnaround in renewable energy policy as well. We've seen a 4-fold increase in the amount of renewable energy that electricity retailers must provide by 2020, which for us is a massive fill-up for a company. We own Pacific Hydro, which is a major renewable energy company, but ironically, and linked to the last slide where we're showing Australian investors investing in English water companies, Pac Hydro has been pumping most of its money into wind and hydro projects in Chile, Brazil, the Philippines and Fiji. And it just beggars belief when we have such an issue here in terms of the demand for renewables. We hadn't had a policy that could accommodate that. That has changed, and now Pacific Hydro will be doing a great deal more here in Australia. So a start has been made, and we really have high hopes for Infrastructure Australia. So what's my view of how federal and state governments should harness Australian superannuation funds capital in the delivery of new infrastructure in Australia going forward? I've got three suggestions. The first sort of requirements I believe that needs to be in place are firm, solid investment frameworks and regulatory certainty around these three key sectors. Water, so that we can start investing within the water sector here in Australia. Energy, the sooner emissions trading system is brought into Australia, the better, and gives everybody certainty in investment decisions going forward. And transport, there are huge demands to invest in ports, railways, urban transport, and again the structures are not really there or conducive to major investment at this stage. In terms of financing structures, I talked about PPPs, and if you remember that slide where we were able to get 7 times the amount of equity away in other transactions and not PPPs, simply because of the time it takes to actually deliver one of those projects. So procurement needs to be streamlined, bid costs need to be reduced, and just make it much more easy and efficient for us to invest in these assets. I think procurement needs to be de-risked. The toll road model, I think, is dead. We will not bid on traffic forecasts that vary based on observed instances by 40, 50, 60%. Why would you make an investment decision on that basis? I think there's a real need for governments to de-risk some of these investment models and to look at alternative partnerships. PPPs are only one route to deliver infrastructure in Australia today. Governments typically do as much work as the private consortiums over a 1 or 2 year period. Why don't they just go that one stage further, finance the transaction and the delivery of the infrastructure up front, and then make it available for sale once it's been delivered and de-risked. Finally, government and industry capacity. I think is a real challenge for governments to actually understand an investor like a superannuation fund. Having Gary Weaven on the board of Infrastructure Australia will be a fantastic opportunity and should really help that dialogue and governments to get to understand what we need in an infrastructure investment. We really need to lift the scale of investment here in Australia 2, 3, 4-fold from what we've been seeing over the last 8 to 10 years. I think there's a real requirement for upping the ante in terms of manpower and resources on the government side, developing skills and paying a decent wage for high calibre professionals. And I've got a quote here from Gottliebsen which really tries to capture that last point about trying to understand the industry superannuation investor. Now, if I just read it out to you, the infrastructure game has changed dramatically in the last year. Some of the government planners don't fully understand the change of rules. And what Gottliebsen's getting at here is issues around the emissions trading system, the need for regulatory certainty. The toll road model is dead. Why would you bid on a very, very high-risk toll road proposition? So he's saying, if the government sticks with the old rules and how things have been done in the past, then superannuation infrastructure money will go elsewhere, probably overseas. And I'd probably correct Gottliebsen there. It's not will go. It actually has been going offshore for a number of years. So just to finish off, if you remember, I had 3 key questions at the start of the presentation. Is infrastructure still an attractive asset class? I would argue absolutely. The individual asset fundamentals haven't changed. Infrastructure assets provide monopoly features, strong, stable cash flows that match the long-term superannuation funds' liabilities. What risks exist in infrastructure investment models? I think risk metrics and their review highlighted the key risks that you should be looking out for. In other words, favourable management agreements, better fee structures, and more sustainable financing structures. If we remember the Con Ed or the North American Energy Alliance case study that I went through, there's a need to keep it simple. Transparency, contestable services, no conflicts of interest, competitive fees. Transurban's move to that model. Embrace the basics of an infrastructure asset and demand transparency from the manager and have competitive fee structures, and you'll do well. And finally, what does the future hold for super fund investments in infrastructure going forward? I think we're starting to see the re-emergence of a very attractive secondary market for infrastructure assets here in Australia. The number of sellers are increasing and the number of buyers are decreasing, and hence we're going to see much more better value deals emerging, such as the EcoGen transaction that I took you through earlier. Overseas markets will always remain sort of deep and attractive to us, so we'll keep investing offshore through our international offices. I think the final 2 points are really a challenge to government. Infrastructure Australia is a great start, but governments have got a huge challenge ahead of them to tap the huge amount of capital that's available. If we remember that $1.3 trillion worth of super fund money that I mentioned at the top of the presentation, I think there's a real demand and need for economic structures and financing models to be redressed, and these are going to be absolutely pivotal to attracting superannuation fund investment back into greenfield infrastructure investment in Australia.